Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. I've got a big one yet again. What we are looking at right now today is a mess, to say the least. The first thing I want to look at is the demand destruction. What are we talking about here? Is that when prices get too high, things go crazy. So that's really what is going to start this video off. The second thing I want to look at is these stocks that have gone haywire. The markets are all over the place. Financial elements are really distorted. I will show you that. And the third thing is the inflation sensation. What are we seeing today? Well, of course, all around the world, we are watching prices rising, and I will give you some examples and things that have happened, all of that and more. Let's begin. A world that's more expensive is starting to destroy demand. If you are a subscriber on this channel, you have heard me talk about this very thing. I've been talking about it for 2 years, and in fact, really since the very beginning. Essentially, that when prices get too high, demand starts to slow down. I didn't invent that. It's not a crystal ball. I've just been talking about it and highlighting it, and now it's starting to make its way into the mainstream media. Now, this right here is a very deep article that covers a lot of subjects, and I wanted to show you some of that. I might have to do some edits and cuts if necessary to get into as much as I can, because this is going to be the major theme in the coming weeks and months. Buyers are balking at high prices for fuel, food, and metals, threatening to tip economies back into recession. That is the topic that you should be focused on as an individual, because if you watch these prices, yes, it's going to impact you directly, but also the markets, also the 401ks, the retirement accounts, and so on. Prices for some of the world's most pivotal products, foods, fuels, plastic metals are spiking beyond what many buyers can afford. That's forcing consumers to cut back, and if the trend grows, may tip economies already buffeted by this issue into recession. Now, you know very well that this has been going on already. Look, people only have so much income. The disposable income that they have, instead, as they mentioned here, instead of being able to go to the movie theater and, buying this or that, the latest iPhone, I think they mentioned, they're not going to be able to do that, and they have to save that cash because they need it for the food and energy and other essentials. So that, of course, is something that doesn't happen overnight, and although the markets can ignore it for a long period of time, we know that, of course, it kind of really takes people by surprise. It takes the markets by surprise as well. So they do cover a few examples. I wanted to touch on that and why this is really key and really important. The phenomenon is happening in ways large and small. Soaring natural gas prices in China force ceramic factories burning the fuel to have their operations. A Missouri trucking company debates suspending operations because it can't fully recoup rising diesel costs from customers. European steel mills are using electric arc furnaces, scaling back their production as power costs soar, making the metal even more expensive. So look at each step of the way. Look at this geographically. Take it any way you want, and it's affecting everybody. Global food prices, you're looking at Ukraine, what's happened there. You know that there are problems. Oil price soars. Electric vehicles could too. Spiking lithium prices could make electric cars more expensive as oil drives up gasoline. And that pink line there is lithium futures. Watching the price rising dramatically just over the last year or so has been quite extreme, to say the least. But it's not just lithium, although it has, you compare what happens with oil, that's the black line, and it looks like it's gone up over the period, but comparing it to lithium, it looks like nothing. But you know that the price of oil has gone up considerably. At the time of this recording, it is at around $110 a barrel. Certainly off from its highs that were experienced recently, but we will see. So here they talk about the demand destruction, squeezing people out of the purchases, whether it's going to be the latest iPhone or PlayStation. You look at this. In here, I believe I did touch on it here today, that essentially right now there are more lockdowns that are occurring to some degree in China, and you know what happens as a result of that. When they are locked down, the whole engine, the machine that is China and the manufacturing is going to then impact and reverberate around the whole world. It signals what could turn into a recession, the slowdown, and everything else that's related. Okay, the price is rising and so on. IMF cutting its global growth forecasts, seeing recession risks in a number of countries. Yeah, obviously that is the case, and you know this. When you have the Federal Reserve increasing interest rates at a time in which things are starting to slow down, they're increasing interest rates, that has an effect, that has an impact. We don't have to deny that. You know that historically. This time is different though. We'll see. We'll see. I don't have a crystal ball, but I could certainly see that what we are looking at right now is concerning. It is concerning for the economies around the world, and especially what we'll talk about more in this video is where you put your money, because you've got to have it somewhere. But do you want it in the latest SPAC craze, the latest, whatever they're creating, who knows? Or do you want it in something more sound? Looking at this, you got the natural gas prices, of course, as well as gasoline, petrol prices rising considerably. You know that. There's little doubt that inflation's going to stay higher for longer as a result of what's happening in Ukraine. A renewed spike in gas prices would see demand destruction becoming more widespread. And I want to really highlight that the fact that they're using the term demand destruction, which is something I keep on harping on and will do in the coming videos. The dynamic is playing out in products as ubiquitous as oil and as specialized as lithium. Battery makers in China, paying 5 times more for the metal than a year ago, have to pass on some of the cost to car companies, potentially slowing down electric vehicle sales. There are pressure on automakers. Yes, certainly, this is going to put that pressure. But people are, initially, well, my house price has gone up. My stock price has gone up. I'm getting paid more because I quit my job and then went over here. So that's fine. But how much pressure can it take? We will see. Okay. The fertilizer prices, they talk about that in here. I mean, it's everything. It's everything. And that's why I really like this article, because it really touched on basically everything. It's like a money GPS video all in one article. Okay. There is more in here. I would recommend checking it out, but essentially that was what I wanted to get into. Now we need to move into the next section. We need to talk about what's happening with commodities. We need to look at the markets as a whole. Shaken by spiking commodities, trading houses adapt to survive. Commodity traders face unstable markets and a credit crunch. This is something I've been discussing here recently, and they do talk in this article about the margin calls. That's right. Right, a price rout and a brief loss of creditor confidence amid 2008's financial crisis set commodities titan Glencore on a path to a public listing. After prices recovered in the years after, merchants like Trafigura moved to tap public bond markets for the first time. Then we've got some problems. And then what happens? Well, the companies that buy and sell crucial materials from oil to metals to grains are scrambling for cash to meet margin calls, with prices whipsawing as war rattled markets. With pressure building, traders are reducing their activity, which saps liquidity and then threatens to only make it more volatile. So you see what's happening here? You got prices rising. But prices rising doesn't benefit everybody and all companies in the financial markets as a whole. Some of these are going to be impacted negatively, okay? Everyone in this room has been working towards adjusting their liquidity, their financial solutions, but also adapting the size of their business in view of commodity prices. You can look at the VIX index, which had spiked. I believe it is down considerably from that point, but you could see, of course, what happens, and this affects different companies for different reasons. High velocity market swings have roots in economic boom thesis. Basically, this article out of Bloomberg is saying that we don't have a reason to worry because markets are going up, prices are going up, things are doing well, and you have that sound foundation here at this time. And they keep talking about how, look, more money is flowing in, asset prices are rising. There is no problem. But I mean, it's so short-sighted. It's strange, but that's the way some of these financial analysts like to look at it. The riskiest bets in the stock market are the most popular. Market swings have triggered a stampede into exotic ETFs. That's right. Look at this. Basically, just saying, giving a personal example in here. This guy's putting in, this much money. He expects it to go to 50,000. At which point he's going to pull that money out because, of course, it's just going to hit 50,000, and that number that he has in mind is the time when he's going to pull out, or maybe he sees it going and, hey, it's not going to stop. If I just leave it in for another month, it'll be 100,000. Is that what happens? Usually does. Most people don't have the strength to pull out when they want to. They think, oh, no, the little dip came in. If I just wait till it gets back up there, and it comes back down. You never know. Okay, so they talk about that in here and some of the extremes. They're looking at these leveraged funds. You may be aware of these. ProShares is one of the ones that they're talking about. Essentially just saying this is a triple leverage. So whatever, let's say this is the QQQ example, so the NASDAQ, if that goes up 1%, this would go up roughly 3%. Okay, it's a multiple of what we see. But if it does bad, well, then it's going to do really bad. Right? So that's the concern, of course. These are a few examples that they cover in here. I'm sure you're already aware, and if not, the specifics, I believe, are not that important. What is important is that more money is flowing into these, more money flowing into the leveraged assets. And so, like, if you look at it broadly speaking, it's an ETF, right? It in itself, if people are putting money in, they're not leveraged in that position, but indirectly they are, because they're essentially saying, oh, it's going to be 3 times whatever direction. So they have ones that are for down markets and up. This is a concern. Okay, it's not being necessarily understood, but that's what we should be aware of. And then we have this. China's economy faces the worst slowdown since the beginning of 2020. China's economic growth worsened in the first quarter. Markets should be concerned about a further slide. Of course, they will not be. And in fact, as I record this video, we're looking at the Hang Seng up considerably. Shanghai is above flat, but they're not concerned about this. There are lockdowns happening right now. I think they call them staggered lockdowns in Shanghai, trying to keep everything open and everything moving. Shanghai being the most important port in the world, they need to keep the factories moving and things coming in and out. But that's not going to affect the market until after. The market, like, no, we can just if we just don't look over there, we'll be don't the bad stuff over there. We're just forward looking. That's what they kept saying in 2020. Forward looking, everybody. All right, then we have this. The latest RV shipments report shows new February high. This continues to go up. It's like this is the hottest commodity. A lot of people are suggesting that it's not just extra cash flowing around and people want that RV so they can go traveling. It's people living in them. So, it really all depends. But that's the what we have today. I'm going to end the video right there. Okay, I had a lot more to cover, in fact, but I wanted to stop right there because this was really informative. I hope you got enough in this video. The real important point here is the demand destruction, and I think that what we see right now with inflation rates rising so high, that is the main concern. Listen and look around. Like whenever I'm talking to somebody, I always ask these questions, very simple questions. What do you see? What do you see? If somebody's a nurse, I could talk to that person. Someone's in the financial industry, I love that. What do you see? Do you see that concerning? What are people around you saying? So I can get that. And I get the same information from the comment section. That's why this is the best, in my opinion, the best comment section that there is, because people actually give factual information, anecdotal evidence. Oh, I went to the store and I saw this, or my brother said that and sister said this. That stuff is invaluable. It's incredible. And that's why I thank you for that. All over the place you can see way more comments in other channels. But the information that I've got just from my own comment section, this is our comment section anyways, not mine. This is incredible. And I want to thank you for that very much. Look, if you want to support this channel, simply hit that thumbs up button. I really do appreciate that. And I'll see you on the next one. Take care.